Like, can you give us a general outline of the complexities of the interest rate environment and where you see it heading in the next 6 to 12 months?
Yeah, so Bank of Canada right now is at 275, which is the midpoint of what they consider as neutral for the Canadian economy, which means it's not going to stimulate the economy one way or the other. It's neutral. It's what rate is consistent with their inflation target being, or their inflation being at target over the medium term. That's kind of the way they think about it. The Fed is still their neutral rates are around like 3, and they're still, what are they at, 4? Are they at 5 or 4.75? Can never remember. They have that range, so I always get tripped up. But they're still well above neutral. So the Bank of Canada is kind of at neutral. Bank of Canada, the Fed is still like in kind of they're not tightening, but like it's restrictive. Yeah, the stance monetary policy is still quite restrictive. But their inflation is also running above 3%, right? So that they're just kind of following what typical kind of rule for setting interest rates would tell you where rates should be. There's the Trump rule, which says that rate should be at 1%. That hard to get that from any standard macroeconomic model, but he's playing with a different set of models, I guess. So what complicates the Bank of Canada's decisions or has up to this point is the tariff question and how much tariffs were going to affect the economy. So back when I was on the show before, me and everyone else that does this kind of work was trying to figure out what the ultimate impact of tariffs was going to be. Were we going to have like a 25% tariff on all Canadian imports to the United States? That would have been obviously very severe. If we retaliated, it was going to have huge inflationary impacts as well. So you saw modeling for the Bank of Canada at the time that said if we had kind of a worst case scenario, then we'd be in a recession for a year with inflation above 3%. So to your typical kind of stagflation, monetary policy in stagflation is really tough because they're mandated to keep inflation at 2%. So that's a very complicated situation. Where we're at now is almost all Canadian exports to the United States are still covered by our free trade agreement. So even though there's headlines like 35% tariff on Canada that Trump sent his letters out to every country and we're going to have a 35% tariff, the fine print on that is, well, everything's actually still covered by CUSMA, and so the effective tariff on imports into the United States from Canada is like 5%. So not really that significant. Significant for some sectors. Forestry is going to get hit hard, aluminum, steel. But most goods that we're shipping are not tariffed at all. We essentially still just cover it as under the free trade agreement. On the inflation side, Canada's effective tariff on U.S. imports into Canada is only about 2%. So really, really low. And now it's going to be 0 because they're ending retaliatory tariffs. So this makes the question for the Bank of Canada a lot less complicated. They don't really have to worry about the inflationary impacts of tariffs on like retaliatory tariffs anymore because we're dropping them, which means inflation is probably going to undershoot its target. We're going to see core inflation coming down in the next few months, and the economy is pretty weak, or at least parts of the economy are weak. And that means they can respond to a weakening economy without having to worry about the inflationary effects of tariffs. So if the economy keeps getting weak and inflation starts trending lower, they can be more aggressive on the monetary policy front.
Do you have a best guess on when you think that actually happens, when we start to see rates cut again?
Yeah, I think they're going to cut in September. If we get a jobs report this week that is similar to the one from July, that was showed really weak job numbers. If we get inflation data, right before they meet to decide interest rates, that shows inflation is still coming down, core inflation especially is still coming down, then I think that gives them a lot of room to be confident that they can cut rates without sparking inflation back up. The important thing though is that's just like the short end of the yield curve, and all of the action on the longer end of the yield curve has been kind of the most fascinating. We had so much volatility with 5-year bond yields tend to drive 5-year fixed rates, and we've seen a pretty significant march upward in 5-year bond yields since April. Mostly, maybe it's global investors losing faith in U.S. dollar assets, which was a popular narrative for a while. Maybe it's just a general normalization of yields. We've had a really weird looking yield curve for a while, so we need to get sort of it's supposed to slope upwards If we're going to have a Bank of Canada that's around 2.5, then we should have a 5-year bond yield that's around 3, and that means probably a mortgage rate around 4.5, right? So that would be normal. Could be we're just getting back to normal on these things. So even if the Bank of Canada is cutting, we might not necessarily see a lot of relief from 5-year fixed rates unless they really signal that they're planning to cut more, and then we can see 5-year bond yields come down.
So, Brendon, just thinking about this, there's a potential where we see the Bank of Canada cutting, so variable rates are impacted, but with the bond rate being what it is, 5-year fixed are going to be sticky or potentially even up a bit. So maybe the Bank of Canada doesn't that cutting doesn't have the impact that we all hope on the real estate market, and just because a lot of people that we've been working with over the last couple of years have been burned very badly in the variable rate with variable rate product, right? And in a world that seems, if anything, only more uncertain, it seems to take that bet, even if it's a way better rate, is tricky at the moment. But I'm just curious to hear your thoughts on kind of how that potentially plays out.
Yeah, so the you think of like a 5-year bond yield is the combination of expectations about what the Bank of Canada is going to do over the next 5 years, and like a risk premium. So the Bank of Canada can influence the expectations through communications. So if they come out in September and cut rates, and they say, the economy looks like it might need more stimulus in the future, that'll impact expectations. Now, instead of maybe markets priced in a 2.5% overnight rate by the end of the year, maybe now it's 2.25, maybe it's 2, and that causes 5-year bond yields to fall because of that expectations component, as long as the risk premium part stays kind of constant, right? So they can kind of influence 5-year bond yields lower, but that risk premium really depends on like global factors, and that's where I think we've seen a lot of the rise in bond yields over the past a couple of months has been just a riskier overall environment. It means that term premium or that risk premium is a little bit higher. It's kind of getting back to normal. But we still could see 5-year fixed rates fall with a Bank of Canada cut if they communicate that maybe they're not done, and it can really influence expectations lower.
It seems to me, Brendon, if I'm hearing everything correctly, the uncertainty index seems to be almost lower this going into the second half of the year than it was the first half of the year. We might be looking at some rate cuts coming up as early as September. We also, the tariff thing seems to be at least absorbed, and people are getting past it, and that seems to be what really changed the trajectory of the market in the beginning of the year. At least a lot of people make that argument, right? That we were kind of felt like we were rebounding, and then the tariffs were announced, and we saw a softening. Does this point to a stronger second half of the year in the real estate market than the first half in your mind?
That was my thought. I certainly was more confident about it before I saw the August data, which doesn't show the kind of continued progress that I wanted to see. So yeah, never kind of reason from 1 month of data. So I'm kind of wait to see what happens in September. But I think we'll have a strong. I mean, we had a very weak first half of the year, so having a stronger second half is a pretty low bar. But I think that we'll see things start to recover. When we did some modeling on this, I think it was in March or April, about some potential paths for the housing market. The one that looks the most likely now is like fading uncertainty and kind of status quo on the tariff front, which means no escalation. And under that scenario, we were back to above like average levels of sales by like the second quarter of 2026. So it's not a straight shot up, but I think we're going to see like gradual progress month after month is really what we're looking for. We're seeing it in most markets. It's just the lower mainland tends to be lagging behind, again, for reasons we don't totally understand yet.
What about inventory, Brendon? Because we've seen, well, I'll let you speak to it, but
Yeah.
generally we've went from 2023, early 2024, like we can't, there's no inventory, to this dramatic spike to levels that we haven't seen for years. Um, is kind of new inventory petering out? Is it normalized? Is it actually is it flooding the market? Like, where are we at with inventory, and what do you expect for the fall?
Active listings are like the highest they've been in more than a decade, at what, around 16, 17,000 in Vancouver. Keeping in mind that over the past decade, we had extraordinarily low inventory. So whenever we say like, oh, it's a 10-year high for inventory, it's not like as alarming as maybe it sounds at first, because what happened over the past 10 years is a rapid acceleration of home prices due to really, really low inventory. So yeah, at like 16,000 is a little higher than what we consider like balanced if we had a market that was back to like normal levels of sales, but it's not that much higher, right? It would be, it's 500 to 1,000 listings above what we would consider like healthy for the long term. So active listings are okay. Once sales pick up, they'll start to come back down because new listings activity is pretty normal. The kind of wild card is on the new side, where there's like 4,000 unsold new units in Metro Vancouver. So if you like, total inventory of units for sale is actually quite a bit higher than what you would see just looking at active listings. There's close to like 20,000 total units available for sale, like that you could move into right now. In Metro Vancouver. So inventory, including new, which is normally not, usually developers don't run with much inventory at all. Most of it's all sold. So the inventory is a bit higher, and some of that inventory is pretty like motivated to move is the other thing. Like, you guys are in the industry, so I'm sure you get all like the incentives that are being offered by developers and everything else. So that's like some pretty motivated inventory that's competing with the resale market. So it adds an extra wrinkle, I think, to everything else that's happening in Vancouver.
And I guess it's anyone's guess as to how inventory, like presumably even with healthy sales volumes, we're still going to be elevated over the fall. But is there any indications? I mean, and we just, Labor Day was what, 2 days ago or yesterday or whatever day we're on here. Is there any indication to how new inventory is going to play out in the fall?
It's a good question. I'm more convinced on like the relist the resale active listing side of things. As sales come back, as hopefully they will through the fall, that'll start to come down and probably would have peaked, because again, like new listings aren't that high. It's really just slow sales that are keeping inventory at the levels they're at. It's not like we're seeing huge amount of new listings hit the market. So active listings are probably pretty stable. On the new side, I don't know. I'm not sure. Obviously, again, that's pretty motivated kind of inventory. Like, are those incentives going to work? Are there enough buyers in that market? The prices are obviously higher than for resale. So I don't know. It's I'm hopeful, I guess, that market will come back as well, and we really need it to. We need that inventory to be drawn down so that we can continue to supply the market in the long term. Like, the longer we have elevated levels of new inventory, the more like other projects get canceled or delayed, and that hurts our long-term supply situation. So, but yeah, I don't have as much insight on the dynamics of the new side of the market. We have terrible data for like new on the, like, it's very like it's good, but it's closely held by developers, so it's really difficult to like get a really good idea of what's happening on like the pre-sale and the like new part of the new construction part of the market.